Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Here's what we're watching this hour. First up, big bank earnings kicking off a strong start for reporting season. We've got full coverage coming up. Plus, we'll have the latest on trade tensions between the U.S. and China. And what do ETF flows tell us about the state of the markets? We'll discuss that and much more on Market Catalyst. Let's start with the major averages. Take a look at what's happening in markets today. We're seeing a rebound happening pretty much across the board here. Not seeing the sort of action that we saw yesterday where one of the indices was really rising more than the others. The Dow up about 350 points to 0.75%. The S&P up closer to 1%. And the NASDAQ, the best performer by a hair, up about 1.1%. I also want to point out what's going on in the Russell 2000 because there's a lot of talk about this index here today. It is hitting a new record high. It's up about 1.4% on the session. There you have the two-day look, but let's look at the year to date because really more than the other major averages, you had seen a sort of languishing here for the Russell 2000 before its inflection higher. It's now up 13% year to date. A lot of the push higher, though, coming from sort of more speculative parts of the small cap universe. The thesis has been for small cap bulls for a long time that rate cuts when they began would start to boost that index, but it sort of happened with the lag. So we're going to continue to watch that action, which has been quite interesting here. We're also seeing the 10-year yield worth mentioning here as we keep talking about the expectations for further rate cuts following the comments from Federal Reserve Chair Jay Powell yesterday that seemed to imply that the Fed was on course to continue with its cuts. And so we see the movement here at 4.01%. Certainly that's the lowest that we've seen this year. If we sort of stretch it on out, here's a 2-year. It looks like we're the lowest since late 2024 here for that 10-year yield. So continue to watch that action. Within the S&P 500 in terms of groups that are on the move. Now, with those bond yields going lower, we tend to see certain groups, certain sectors that perform better. One of them is real estate, which is interest rate sensitive, and one of them is utilities. Both of those leading stocks higher, along, of course, with financials, which came out with earnings, but energy also trading higher here today. So everything is in the green, all of the sectors within the S&P 500. Let's dig into the banks a little bit more now. Bank of America and Morgan Stanley reporting stronger than expected third quarter results, boosted by a surge in deal making on Wall Street. Joining me now, our banking reporter David Ellison. So, Dave, really this seems to be continuing what we heard yesterday from the big banks as well. What stands out from these two?
Yeah, exactly, Julie. And yeah, just to take a step back, it is kind of interesting. There's a natural tension going on because the big banks are riding pretty high right now. And for Bank of America and Morgan Stanley, which came out with results this morning, what stands out is that they both sort of have their own places of strength. Morgan Stanley's equity underwriting business that does IPOs had a record quarter. Bank of America had set a record for its lending margin, its net interest income. And if you go back to yesterday, there were also a lot of records from the other banks too. Just to go through a few, Goldman Sachs has, over the third quarter, actually crossed the $1 trillion mark in terms of the amount of M&A volume it's advised on so far year to date. It's ahead of peers on the league tables as far as that's concerned. Wells Fargo also increased a key profitability measure, and JP Morgan Chase is on pace with yesterday's results, depending on how the fourth quarter goes, to set another history for profits in banking history. So we have a lot going on here, and across the board, it looks good and better than what analysts had anticipated.
Dave, thanks so much for that roundup. Appreciate it. We're going to dig now more into whether investors should be buying these stocks. Third quarter bank earnings off to a strong start. My next guest says street estimates will be inching up for 2026. Joining me now, David Ellison, Hennessy Funds portfolio manager, who focuses on these financials. So David, it seems like, the stocks were a little bit mixed yesterday, but it seems like by and large, that these results have been looking good. You just heard some of the trends that David Ellison was talking about. What do you think of their sustainability now going forward?
Well, I think the issue, as David pointed out, I think it was a great quarter. Wall Street was great. Loan demand was decent. Spreads were a little better. Credit remains very good. So it's like, okay, so what's going to get better from here? It's the old stock market. If there's nothing to get better, then there's nothing to talk about. And I think it's going to be a struggle for a while until we understand where the economy is headed in a bigger sense. But I think what this quarter tells you is that generally the economy as a whole is in good shape. The banks are growing loans faster than they've grown in a long time. Margins are a little better. Credit obviously is a big thing that everybody worries about, and it looks like the banks are, building reserves if they need to, but the credit trends are just not that negative, even though people worry about auto delinquencies and a few other things that are popping up. So I think this bodes well for the rest of the earnings season, not just the banks, but all of the other companies.
Let's pull on that credit thread a little bit more, David, because yesterday, of course, J.P. Morgan mentioned Tricolor. We know First Brands, that auto parts company, also running into some trouble on the credit front. How are you thinking about, as you said, it doesn't look like right now that it's creating a big negative ripple effect, but what are you watching? How are you thinking about it to try to assess the risk there?
Well, I think it's sort of, that's why you come to work every day and watch the economy and see what's happening. I think generally the banks are just a lot more willing to say, you know what, I'm going to write it off and move on. I'm not going to try to hang on to it. I'm not going to try to reset it or renegotiate it. And the banks have the profitability to do that. And they haven't historically had that. So I think you've got an industry that says, look, credit card delinquencies are rising. We're just going to cut it off. We're going to write it off and move on. So they're not going to let the bad stuff build up in the system, which is historically what they used to do. So I think you've got a banking industry that has a much more get rid of the stuff, move on. Let's not try to, have all the stuff build up in the system and then blow up all at once. So I think it's a much more disciplined system. People have been worried about credit for a decade. Jamie Dimon and myself are roughly the same age. We both went through 2008. We know what that can do. Nobody wants that again. And so I just don't think we're going to have it, at least in the banking industry.
Yeah, definitely not something that that we would repeat, hopefully, although usually these crises unfold in a little bit of a different flavor, but hopefully we won't repeat any of it. David, as you look across the largest banks here, which we've now all heard from all of them at this point, would you own all of them? Are there any that you think are less attractive or more attractive within that universe?
Well, I think on valuation, Citicorp is clearly the cheapest. Citicorp and JP Morgan roughly have the same book value. And one is at 100 and one's at 300. So just from a valuation perspective, Citicorp has a way to go. Of course, they're not earning as much and have had issues, over the years, but it seems like they're getting their footing. And if you want to own something for the next couple of years and watch it improve from a low base of earnings from respective return on equity and assets, that's the one to own. But I think you can own all of them, all of the big four, the big five. They have the profitability to invest in the business. We haven't really talked about AI yet, but Goldman Sachs was interesting yesterday saying that they're using AI to reduce expenses or reduce headcount. So that's an interesting comment to make when you're doing so well. And if they're doing it, everybody else is going to do it. So if you look at the industry, the profitability of this industry has not changed in 40 years. The return on assets and the return on equity are roughly the same as they were 40 years ago in terms of the high performers. And so if we can get a break from that, either using M&A, using deregulation, using AI, or whatever else you want to use to break out of that and have higher returns over the next couple decades, then the stocks can really move. And that's what I think is the big opportunity, is to break out of this historical range of profitability, and hopefully that will show up in the stock prices.
Yeah, that's a really interesting development. I mean, it applies to a lot of industries, but it'll be really fascinating to see how it applies to financials. David, great to catch up with you. Thank you.
Yeah, you're welcome.
Treasury Secretary Scott Bessent and U.S. Trade Representative Jamieson Greer just wrapping up a press conference on U.S.-China trade tensions. Yahoo Finance Federal Reserve correspondent and Washington correspondent Jennifer Schomburger was there. She brings us the takeaways. Hi, Jen.
Good morning, Julie, to you from the cash room here at the U.S. Treasury. Both Treasury Secretary Scott Bessent and USTR Jamieson Greer slamming China for violating an accord struck in Geneva earlier this year by asserting new restrictions on the export of rare earths. Jamieson Greer calling this, quote, a supply chain power grab and an exercise on economic coercion on the global economy. This behavior, said Bessent, threatens decoupling from China's economy, though he said that there are conversations going on at a staff level between the U.S. and China right now as the IMF World Bank meetings happen right here in Washington. Bessent tried to cool the temperature as well during his remarks, noting that he is going to head to South Korea ahead of that all-important APEC meeting where he will have conversations with his counterpart. And he says Trump is still expected to meet with Xi as of talking to the president last night about this very matter. Bessent stressed that the U.S. does not want to decouple from China, and we just want to diversify our supply chains. Bessent said that it is possible we're in what he called a 90-day roll right now when it comes to the threat of reasserting tariffs, that could be prolonged if talks continue to go well. He also called separately on moderate Democrats to, quote, be heroes and reopen the government as we are in day 15 now, 2 weeks into this government shutdown. Julie?
Jennifer, thanks very much. Appreciate it. Coming up, much more markets action. We will be checking on some of the oilseed processing companies next. President Trump bringing cooking oil into the ongoing trade war, posting on social media, quote, I believe that China purposefully not buying our soybeans and causing difficulty for our soybean farmers is an economically hostile act. We're considering terminating business with China having to do with cooking oil and other elements of trade as retribution. As an example, we can easily produce cooking oil ourselves. We don't need to purchase it from China. For more on what this means for both trade and domestic cooking oil producers, I want to bring in Heather Jones, founder of Heather Jones Research. She spent years covering the sector. Heather, thanks so much for joining us.
Thank you for having me, Julie.
So, I think that not a lot of people know a lot about cooking oil. And so I think we need to start there because my understanding is that cooking oil imports that we do from China are mostly used cooking oil, if I have it correctly, that is then recycled into fuel. Is that correct? Like, what is this market like?
You're correct. It is used cooking oil. And typically this is the kind of vegetable oils that would be used in QSR restaurants to cook French fries, etc. And after that oil has been used and is old, it's collected by processors like Darling Ingredients, and it goes into primarily biofuels. It's used primarily in biofuels, but it starts out as like soybean oil, canola oil, etc.
And since we have seen the Trump presidency, right, there's been a drop in demand for this because part of the demand had to do with policies put in place by the Biden administration, right?
It did. They basically didn't put any restrictions on, but since Trump has come into office, there's been changes in the tax incentives. There's been tariffs put into place, and also there's been some changes on the China side that has resulted in a reduction in exports to the U.S. And year-to-date exports are down roughly 40 to 45%. The reason we're still importing some volume is that if you are located in a foreign trade zone and you use UCO for biofuel that will be exported, you're not subject to these tariffs. So it's still economical for those renewable diesel producers to use Chinese UCO.
And so when President Trump makes a threat like this, I mean, we've talked to soybean farmers, by the way, who say definitely that China is not buying their soybeans and that it is hurting them. But when you look at that leverage versus the leverage on our side, I guess what I'm asking is this sort of a substantive threat that the president is making?
It's not, but I honestly, and this is clearly just my opinion, I don't really think that's the intention. I think it's this is a move to help farmers. I think the Trump administration likely knows that this is not something that they're going to be able to use to exert much leverage over the China trade negotiations, but it would be a substantive help to U.S. farmers because year to date on an annualized basis, Chinese UCO represents around 3 to 4% of biofuel feedstocks, which is a meaningful number in that market. And I think this is something to basically buy time until a formalized biofuel policy comes out in early 2026 that I think will be very bullish and constructive for U.S. farmers.
And there's what it means for the farmers, and there's also what it means potentially for oilseed processors. I couldn't help but notice that Bunge, which is one of the biggest oilseed processors in the U.S., is up today. It also reported its earnings, right? And it talked about the acquisition of a company called Viterra and the effect that's going to have long term. So, Heather, how are you thinking about Bunge and other oilseed processors and how that relates to this whole picture?
So one of the reasons Bunge is up is they provided updated guidance, and I think there were fears that the Viterra dilution was going to be far more than it ultimately ended up being. But ADM, Bunge, they would be helped dramatically by a permanent or semi-permanent reduction in Chinese UCO imports, because basically every gallon or pound we reduce imports of Chinese UCO by, soybean oil is the most likely replacement. So it's very bullish for the ADM and Bunge's of the world. It's also bullish for Darling Ingredients, which they're the biggest UCO processor in the U.S. And they're the ones that go around and take the used oil from like the Wendy's and the McDonald's of the world. And so they're the biggest seller here. So ADM, Bunge, and Darling would be the primary beneficiaries of this change.
So I'm interested in how you think this is all going to play out, Heather, because it doesn't sound like you think necessarily this will be a sort of permanent ban on these types of imports.
I mean, Trump has articulated a U.S. first policy across the board and is playing that out on the U.S. Biofuel side as well. So I do think differentiated tariff systems will stay in place to prioritize U.S. produced feedstocks. But my gut is that a permanent wholesale ban on Chinese UCO is unlikely to stand. And once we get finalized biofuel policy, that will be very helpful to the U.S. farmer. My view is that that ban will be relaxed somewhat.
Heather, thanks so much for walking us through this. It's a topic not a lot of people know a lot about, so we really appreciate your perspective. Thank you.
Thank you for having me.
Coming up next, we got the calls of the day to watch. You're watching Market Catalysts. Welcome back to Yahoo Finance. I'm Britt Obama, live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. NVIDIA, Nike, and Logitech. First up, NVIDIA. HSBC upgraded the stock to buy from hold based on the ongoing demand for artificial intelligence. The analyst said he sees room for significant estimated earnings upside in fiscal year 2027. He also said recent deals could provide a potential boost to revenue, specifically around its artificial intelligence GPU or graphics processing units. Next up, we have Nike. BTIG initiated coverage on Nike with a buy, calling it a top pick for 2026 and setting a price target of $100. Now, keep in mind, right now the stock is nearly $70 and the street has an average price target of $84.
The BTIG analyst has said the company is making progress on its turnaround strategy under new leadership, including that new CEO, Elliott Hill. The firm also pointed out to the improvements in its running and wholesale segments in its latest quarterly results. And lastly, Logitech. Citi upgraded the stock to buy from neutral with a price target of $130 per share. That's up from a previous price target of $100. The analyst said that channel checks indicate positive demand for video conferencing equipment as workers head back to the office. And also those gaming accessories are also in high demand as well. That stock is up nearly 30% year to date. Keep it right here on Yahoo Finance. We'll be tracking all the market moves and top calls throughout the session.
Now time for some of today's trending tickers. We are watching regional banks, Apple and Abbott. First up, regional banks, Citizens, First Horizon, and PNC all out with earnings. Both Citizens and First Horizon reported earnings per share for the third quarter that beat the average analyst estimate. PNC, meanwhile, saw its more expensive commercial deposits grow faster in the third quarter. That weighed on net interest margins, which pushed the bank further from its year-end goal. Citizens up a little bit here. First Horizon plunging by nearly 9%, PNC off by 4%. Next up is Apple. It's updating its top-of-the-line products with its in-house chip. The refresh will be for the iPad Pro, MacBook Pro, and Vision Pro. All will use the M5 chip except for the headband and the Vision Pro. Across the board, Apple is touting the M5's faster artificial intelligence processing capabilities. Besides the M5, the company's outfitting the latest iPad Pro with other in-house components as well. All of this comes ahead of the crucial holiday season. And finally, Abbott cutting the top end of its earnings guidance. The Trump administration launched an investigation into the medical device sector that could lead to tariffs on its biggest product category. But Abbott says it would not expect to see a meaningful impact from potential tariffs. Abbott's quarterly sales were $11.4 billion, matching Wall Street expectations. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, much more markets action. You're watching Market Catalysts. Oura, the maker of the wearable health and fitness tracker Oura Ring, completed a Series E funding round worth over $900 million. That values the company at $11 billion. The company also just released its first ceramic model. That's available for $499. And by the way, it's expecting a total of $1 billion in sales this year. Joining us now, Tom Hale, the CEO of Oura. Tom, I got to kick it off by telling you my husband has an Oura Ring and he shares his sleep score with me very frequently, so I'm familiar with the product by proxy. I'm curious what you are going to use this latest funding round to do. What does expanding growth look like for Oura, and how are you going to deploy that capital?
Well, the first thing, of course, is AI. It's no surprise that high quality data continuously collected is what's required to make really accurate predictions and inferences about your health. And that's an area of investment that we've been investing in for several years, but I think we really want to take it to the next level. The second thing, of course, is international. Today, we're largely a business focused in the United States, but we want to take our business on the road and expand around the globe, and we expect to see that drive growth for the next several years. And then the final thing, of course, is we are mission driven, and our mission is to make health a daily practice. What we expect to be able to do is to start to work our way into the healthcare industry. Today, we work with insurers. In the future, we expect to work with insurers and providers and clinicians, and expanding our product platform and technology platform to work in hand with traditional healthcare is a big part of our investment going forward.
So, Tom, put some of that together for me, in particular the AI and the healthcare piece, because ideally, one would see a future where you could use a tool like an Oura Ring or whatever tracker you're talking about to be predictive, right? To say you're at risk for a heart attack or what have you. Here's the signs. Here's what you need to do. How far away are we, or are we already there, in terms of that kind of functionality?
So today, for example, Aura can look at your biometrics and make a prediction about your health status in a couple of days. The feature is called Symptom Radar. It looks at several biometrics, looks at what's normal for you, looks at the trends in your health, and can say something like, "Hey, you're showing major or minor symptoms that are expected for you in the next couple of days." And that's a very short time horizon prediction. This has been incredibly useful for lots of people. I used it personally to help stay healthy when I'm traveling. I'll take a day and rest and break so that I can recover without getting sick. But it's really surprising and powerful how accurate it can be. You think you don't feel any symptoms at all, and then 3 days later, you're on the couch watching Netflix surrounded by Kleenex. This kind of prediction, that's a short-term prediction. But the density of data and the quality of data that we can collect, including data from the ring, but also data from outside, things like I'm wearing a glucose monitor right now, or we recently introduced blood biomarkers where you can actually sign up and get those tests taken, and then we'll bring them together inside of your Aura experience. Adding all that data together lets us make longer term predictions. And I think the way to think about this is that it's almost like a doctor in your pocket. You've already got a supercomputer in your phone. You've got a device on your body that's measuring, kind of clinical grade data on a constant basis and looking at you overnight, which means your body's at rest. So we get a very good signal, and then feeding that information to a machine intelligence, which is looking over you. And it's not just the doctor, in your pocket that's sort of saying, "Hey, something's going to happen to you. You got to watch out for." It's also trying to steer your behavior in kind of that preventative medicine way, where it's trying to influence your behavior to help you live a longer and healthier life. AI is the foundation of all of that. And if you think about medicine today as being practiced on the averages, and you go to the doctor once a year, the difference is that this AI will be personalized to you. It'll be custom to you. It will know your data, your context, your genotype, your phenotype. In the future, that's the future of medicine. And it's not only personalized to you, but it's also predictive and can work with your clinician to help them understand what's going on with you, like a co-pilot for your doctor.
Tom, I have so many questions for you. I'm curious what you make of this sort of criticism of this type of hypervigilance and transparency of the data, that it actually increases anxiety, can increase, sort of overdiagnosis or misdiagnosis in some cases, because you are people can obsess over having all of this information.
Philosophically, I think our approach is that we want to recede into the background. We don't want to be reminding you every day of your mortality and to create some anxiety. We try and make the experience be as low impact as possible. I think that's actually partially because we don't have a screen on the device. It just sort of is there monitoring you like a guardian angel in the background. But when you need it or want it, it's available to you, and you can investigate it at your leisure. Now, that being said, there certainly are people who I think become overly obsessed. I don't know if your husband talking to you every morning about his sleep score qualifies, but the point is that the information is power, and that power, you can use it to live a healthier, longer life. And I think that's incredibly important. The idea is to give you agency in your health journey. And I think this is a trend that's been going on, for decades, as people have learned more and more and gained more access to health information. Scientific papers are available on the internet. Everyone can become an expert. Now, that being said, we don't want you to be obsessed. If you are obsessed, please, take the ring off. Give yourself a break, because one of our core values is that you should live a life of balance. And balance means, finding the right, set of circumstances for you in your life where you are. We want to meet you where you are right now and give you the power to drive your own health journey and not be just a passenger on the bus.
Right. Tom, it's rings now. You guys are still a fairly young company. But do you see other types of the ring is pretty unobtrusive, but are there other form factors that you're looking at?
I do see that in the future we'll have a cloud of wearables that are appropriate to the use case. For example, a diabetic is probably going to wear a blood, sugar monitor on their body. There will be other wearables. I think we see the world where glasses might interact with your ring in an interesting way. We've seen demos where wearing smart glasses, you raise your ring, and your data is displayed on the surface of the glasses. We think that the cloud of wearables is going to be a really interesting kind of way for people to monitor and manage. Obviously, I don't want it to be overwhelming, but we've seen really cool prototypes. We've got, earrings that are measuring your brain waves. We've seen things that sit at pendants on your chest. The thing about the ring is that it's actually the best spot on your body to measure. And the reason for that is that it's, the sensors are so close to the blood flow. There's arterial blood flow right underneath your skin here. And you can contrast that to the wrist where, you've got hair, bone, sinew, all these things that are confounding factors. So we get a much, much stronger signal at the finger. That's probably the most important reason to think of the ring as the foundation wearable in your cloud of wearables.
Tom, the other thing I wanted to ask you about is when you have something that is a powerful tool to measure your health, but it is a premium product, right? The cost is a premium, you're paying a monthly fee. How do you think about, or do you think about increasing accessibility of something like this?
Access is key. Our mission is to make health a daily practice, and that's for everyone. Health is a fundamental human right. We are aiming to increase accessibility through multiple ways. The first way, of course, is through funds that are pre-tax. So your HSA, your FSA, your flexible spending account, or your health savings account, you can use those on the Aura product and the Aura subscription. And that's, in some sense, that's a way of providing access to people who have set money aside pre-tax for their health. The other way we want is to continue to work with insurance companies, because insurers, they have a real incentive to keep you healthy, whether it's life insurance or health insurance. And we do that today. We work with lots of folks like we work with Essence, which is a Medicare Advantage provider. We work with insurers like who have programs around your health, like Vitality. And what they're basically doing is helping to subsidize and give you access to the ring because they have an incentive to keep you healthy. Ultimately, this might even extend all the way through Medicaid and Medicare. It doesn't, we're not covered by Medicaid and Medicare today, but you can imagine a future. And I think actually our RFK Jr. has imagined a world where wearables are part of the preventative medicine regime to help keep people healthy and happy. Because if you can solve people's health problems before they get them, you reduce the burden on the system. And we all know that the cost of health, it piles up at the end of life. And if you can make those decisions in the early part of your life to be healthier, build those healthy habits, we can bend the curve on the costs.
Tom, thank you so much for joining us. Really interesting discussion. Hope to see you again soon.
Thank you. Take care.
ETF net inflows crossed the $1 trillion mark last Friday, well ahead of last year's $1 trillion achievement that was reached in December. So where are people putting their money, and why do ETFs often rise when we see equities fall? Joining me on today's ETF report to break it all down, Todd Rosenbluth, TMX VettaFi Head of Research. Todd, good to see you.
Great to be here with you.
So why are ETF flows running so far ahead of where they were last year?
Well, we've seen investors, advisors, even some institutional investors embracing ETFs, both to get core equity exposure. S&P 500 based products have been quite popular, and more tactical plays. So we've seen thematic ETFs be increasingly popular. Fixed income ETFs are popular. Bitcoin ETFs are popular. Really, we've seen most categories see significant growth, and it's actually quite rare that we see an ETF with notable outflows. This has been a great year for ETFs, and we're easily going to pass the record that we set last year of $1.1 trillion, probably by November.
Todd, I'm curious where the money is coming from, right? Is it sort of increasing market share of ETFs pulling from mutual funds? Is it new money coming into the market? What do we know about that?
So we believe that some of that money is going out of equity mutual funds. We continue to see outflows from actively managed equity mutual funds. Some of that is going into S&P 500 index-based products like Vanguard 500 VOO that is on pace to easily cross $100 billion of net inflows real soon. And we've also seen through thematic investing. So instead of choosing an individual stock to get exposure to an individual theme, we've seen thematic ETFs. So Nukes, for example, NUKZ, is an ETF from Range Resources. It's providing exposure to nuclear energy, which is tied into that artificial intelligence boom. We've seen investors embracing thematic ETFs like Nukes to get exposure. You get the benefits of diversification, not choosing an individual winner, but spreading that risk around.
And there's also been sort of the reignition or reacceleration maybe of the sort of retail-driven trade. I'm sure Nukes, part of the move in that is that literally the ETF called Meme came back also after it was shuttered in 2023. Roundhill rolled out again. And then there's the Dan Ives AI Revolution ETF, which has grown quickly as well. What do you make of I mean, one would have to think that retail investors are also a significant driver of all of these flows.
That's true. And certainly with thematic investing, thematic strategies like artificial intelligence or nuclear energy, that's more likely to resonate with an individual investor, retail investor, than certainly an institutional investor. Dan Ives has a strong brand. He's well known as an AI or a technology analyst, and his ETF has quickly been gathering assets. It's exposed to some of those Mag 7 stocks, but with an actively managed approach. We're also talking to investors about Think, THNQ, which is a Robo Global Artificial Intelligence ETF that has exposure to some of those up and coming artificial intelligence companies. So more than one way to get exposure to one theme in particular, and certainly research-driven approaches overall.
Todd, I want to switch gears and ask you a sort of plumbing question, if you will. And it has to do with Bitcoin and the Bitcoin ETFs, because something that we've noticed, and this isn't unique to Bitcoin ETFs, it's just one example that we were looking at, is that the ETF does not always trade exactly in tandem with the underlying asset. In this case, we looked at IBIT, which is the biggest spot Bitcoin ETF, the BlackRock one, versus underlying Bitcoin. And you see they don't always trade like neck and neck. What explains this, and what do investors need to know about it?
Right. So when you're buying an ETF, you're paying a price that the market is willing to both buy and sell and meet in the middle for, as opposed to the net asset value. So typically that there's a little bit of a deviation between an ETF's price and net asset value if it's based on underlying securities and whether the market is getting ahead of where the ETF is or vice versa. When it's a spot security like Bitcoin or gold, you'll see some differences. Many people are still embracing IBIT. You mentioned it. It's the largest. It's going to cross $100 billion real soon in overall assets. It'll be the fastest one to be able to do that. We've seen strong interest in Bitcoin ETFs getting spot exposure, as well as options-based strategies. So Calamos has rolled out some options-based downside protection ETFs. Neos has an ETF, BTCI, that offers a covered call strategy. The ETF industry has benefited from having Bitcoin exposure available to many investors.
And so it sounds like the sort of, minor discrepancies between the two is not it's not something that investors need to be concerned about.
I don't think so. I think if you're buying the ETF, you're choosing to do so because of the benefits of an ETF, that you can trade it intraday, you have the liquidity, that it fits into the rest of your portfolio. It isn't always the same thing as getting direct exposure. So if what you want is to follow the price of Bitcoin, you might want to do that outside of the ETF wrapper. But if you want to have Bitcoin within your broadly diversified portfolio, a Bitcoin ETF, options or not using options, is a great way, in my opinion.
So, and obviously the crypto ETFs have been one of the other big growth areas this year, right? When you're talking about all of the money that's come in, thematic, retail investors, crypto, what are some of the other, like if we're looking over the next 3 to 6 months, even going out into 2026, what are some of the continued trends that you think are really going to draw a lot of these flows?
So what we haven't talked about is thus far, you and I, is fixed income ETFs. So right. Fixed income ETFs already have set a record for net inflows for the year, which is just impressive. The Fed is likely to continue to cut interest rates. Investors are likely to turn towards fixed income ETFs that they can get higher opportunities for. From a return standpoint, we've seen the benefits of actively managed ETFs gain traction. The likes of Capital Group and PIMCO and T. Rowe Price among the firms that have seen success in recent months. We think active fixed income ETFs and fixed income ETFs in general is an area to focus on as we head into 2026.
Todd, great to see you. Thanks so much.
My pleasure.
Coming up, we got full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst, first up, stocks rebound as risk-on appetite returns to markets. We'll have full market coverage coming up. Plus, as the shutdown continues, we'll tell you what it means for Social Security's cost of living announcement. And as trade talks remain in limbo, we'll hone in on what it means for the shipping industry. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets. Taking a look at the major averages here, we see an extension of gains right now. The Dow at the moment up almost 300 points. We've got the S&P 500 up better than 1% and the Nasdaq up about 1.3%. This as we have bond yields coming lower today. Speaking at a press conference in Washington, U.S. Treasury Secretary Scott Bessent said the U.S. and China are aiming to de-risk the ongoing trade war. He also confirmed that President Trump is still set to meet with Chinese President Xi Jinping later this month. So what does this mean for investors in both U.S. and emerging markets? Let's bring in Jay Pulaski, TPW Advisory founder. Jay, it's good to see you. Again, we're sort of back to the day by day trying to figure out where the trade winds are blowing. After taking the market sort of off guard last Friday with his comment, things have settled down to some degree. But what's your read of the situation and what it means for investors?
Julie, great to be with you. And I think it's really interesting. The U.S. has really had its own way in terms of sanctioning other countries for several decades. And so we've become more and more used to reaching for that tool or that instrument in our kind of political toolbox when we want to deal with other countries, particularly, countries that we're not pleased with. And so I think what we're dealing with today is something quite different, which is for the first time, really, the U.S. is on the receiving end of being sanctioned and is not really prepared for it and doesn't like it. And so responds, impetuously, as we saw over the last couple of days. And so I think, you go back and track Secretary Bessent's comments over the last 4 or 5 days, it's all over the place. And so I think it's not really worth spending a lot of time listening to the administration here. We're going to meet with China. I think it's quite clear that China has made it clear in turn to the U.S. that A, it doesn't need NVIDIA chips. That was a statement made by the Chinese government several weeks ago. And B, the U.S. does need China's rare earth dominance. And so in terms of who has the upper hand here, I think it's China. And so we're operating on the assumption that in the coming quarters, there will be a rapprochement between the U.S. and China that quite possibly could include a signal to U.S. institutions that it's now okay to buy Chinese equities, something that they've been really kind of adverse or unwilling to do since the first Trump administration. And that could set off, in our view, another big leg up in Chinese equities.
I want to dig into that, Jay, but I am curious about one thing that you talked about, which is that you shouldn't put much stock in the sort of back and forth commentary that we've been hearing from the Treasury Secretary. But why put stock in it when China says we don't need NVIDIA chips? I mean, why is that not a little disingenuous as well?
Well, because I think evidence is increasingly clear that China has gotten to a point in the semi space and in the artificial intelligence space where it's a peer of the United States. If you look at open source models, for example, several years ago, of the top 5, 3 or 4 were U.S. Most recently, the top 5, all of them are Chinese. If you look at Huawei's public statements over the last couple of weeks, which is quite unusual for a Chinese tech company to publicly talk about how it's going to move up the ladder of expertise and compete with NVIDIA. They laid out a 3-year plan to do so publicly. And so I think it's not that China has gotten to a point where it's as good as NVIDIA. No, I'm not saying that. What I'm saying is that China is comfortable positioning itself to compete with the U.S. without any U.S. inputs into its tech stack. And something we've called Splinternet. We've been writing about it and talking about it for years, and it's really manifesting where the two countries, U.S. and China, their tech stacks are increasingly being separated as AI becomes kind of a weapon that both sides are reaching for to, in their view, potentially control the global economy and the global security setup.
And so, Jay, do you think that U.S. investors should already be buying Chinese tech stocks in particular?
Oh, yeah. We've talked about it before, Julie. Yeah. China tech has been dominant performance-wise versus the U.S. for several years. This is one of the best-kept secrets on Wall Street. KWEB, the China tech ETF, is up close to 40% year to date versus the Q's up less than 20. They now dominate the China tech space, which is much bigger than the U.S. tech space, growing much faster than the U.S. and trading at a third to a half discount in terms of valuation. So yes, we have been and are and continue to be overweight Chinese equities within our global multi-asset model. We expect to continue to be that way. And as I said, I think the opportunity, the potential is really twofold. First, that there's a rapprochement and Trump signals that it's okay to buy Chinese equities. Second, and perhaps more importantly, is what China is doing to fight deflation in its own country, in its own economy. And we think they will have success in that fight. It's one of the reasons why we're bullish global growth for next year. And in so doing, better inflation means higher corporate earnings, which means greater multiples, higher stock prices, and et cetera, et cetera.
And if there is no rapprochement, does China have the tools that it needs to still fight deflation? You know, if they're not, if the U.S. is not buying, for example, if they're not getting that influx of capital from the U.S.?
No, I mean, the U.S. has become less and less important to China. China got the message in the first Trump term and has been working hard to de-risk itself from the United States. And you can see that in terms of the trade, which you mentioned. The U.S. is now about 15% of Chinese exports. And keep in mind that, you know, exports are only a small part of China's overall growth in terms of the economy as a whole. And so it's less and less important. What China has done has turned a weakness into a strength by shifting those exports from the U.S. to the rest of the world, particularly the global South. And so where Chinese exports are growing most rapidly year over year are Southeast Asia, and therefore they're integrating the Asian economic space, which is a big theme for us in our tripolar world thesis. And then secondly, they're expanding into Africa, which is the second fastest growing recipient of Chinese exports. And a lot of people talk about dumping and this and that. And look, the reality is that people are not being forced to buy Chinese exports. China is increasingly doing and producing things that the rest of the world wants and needs, particularly in the high-end space of renewables. China's dominance in the renewable energy space is now becoming a major factor in allowing them to reduce exposure to the U.S. and become more integral to other countries as they seek to lower their power costs, which in turn is becoming a real competitive advantage. Renewable energy, lower power costs, those are the drivers to national growth, we believe, in the coming years. And it's something, of course, which the U.S. is rowing back aggressively against the rest of the world, which I think is sadly not going to end well in terms of relative competitiveness.
Jay, great to see you. Thanks a lot.
Always a pleasure, Julie.
Coming up, we'll talk market volatility and options trading as earnings season gets underway. Stay tuned. Trade tensions bring volatility back to the market. The VIX surging on Friday after President Trump threatened an additional 100% tariff on China. While the volatility index is lower today, it's still up over 16% in the past 5 days. And with earnings season underway, traders are expecting an upswing in single stock volatility. Here with me in studio, Henry Schwartz, CBOE Vice President of Derivatives Market Intelligence. Good to see you.
Happy to be here.
And good timing, given that we've seen that uptick in the VIX once again.
Yeah.
How should we be reading it?
Well, Friday was, I guess, a bit of an unexpected move. Everybody's kind of been talking about how this market is, felt kind of overheated, and we'd just been kind of grinding higher, and everybody knew the headline risk was out there. I mean, this is how the administration works. So, people were surprised. It was, we actually had a new market record of 110 million option contracts trade on Friday. So, blowing through the prior record, which was set in April of 104 million contracts. And, we're actually averaging around 70 million contracts a day this month. So compare that to pre-COVID, we were averaging around 18 million contracts a day. So volume has exploded. And then Friday was the kind of move that, when we get a 2% sell-off, volatility spikes, people definitely get spooked. What was kind of interesting about Friday was, we've been through this kind of tariff routine before. So we actually, as much as VIX was up about 5 points on Friday, when you kind of decompose it into, VIX is made up of an entire strip of SPX index options. It was actually the upside calls that were contributing a decent amount to that, which in a true kind of moment of fear and risk off, where everybody's kind of like looking at the downside, that's not where we see the interest. We see the interest in panic puts. And we didn't really see that on Friday. And then, really we did get a rebound. It's been a little bit choppy. VIX is still around 20, which really, does tell us we're gonna continue to see moves in the, the 1%, maybe even 1.5% a day range. For a while, but it's we were talking about this before. It's been a pretty amazing time for the market. We're still up about 13-14% year to date in SPX. Russell, Nasdaq, everything is just very, very strong.
Yeah, and maybe that call, and that's something. It's a good point. People forget volatility works to the up and to the downside, right? But maybe that call buying also was sort of a precursor to people buying the dip coming back in on Monday, that impulse is sort of alive and well in the market also.
I mean, that impulse is what's worked really for the last several years, right? So there's a very strong kind of reflex to buy the dips. Now, when you get a 2% sell-off and volatility spikes, people definitely kind of take a breath and try to figure out, okay, is this going to be a 5% sell-off? Is it going to be something like what we saw in April? But really, because we navigated the April kind of tariff on, tariff off, I don't think people are quite as worried about that. But what's really interesting now is we're into this. There's a lot going on. We got tariffs. We still have geopolitical conflict. And then we have earnings season. So everything, is kind of coming at you from all sides after what was, kind of a quiet September.
And I know the VIX curve was sort of flipped, right? And for, I don't know if it still is today, but in other words, people were buying more protection for the short term than the long term, which is unusual. People are usually more cautious about further out than they are about right now.
Well, it's become, having short dated options and even zero DTE options has made it much easier to kind of do tactical hedging. Really, if you want to hedge for this week, you can buy an option that expires on Friday. If you want to hedge for the rest of the day, you can buy a zero DTE option. So there has been a shift in kind of some of the hedging activity. In a way, it's actually kind of bifurcated. We still continue to see the big systematic hedges, big put spread collars that we see in SPX. Those are usually 30 to even 90 days to expiration. And then we continue to see, 2.5 million contracts a day in the same day options. And that's a blend of people kind of tactically positioning for what they think is going to happen for the next few hours, and also kind of some systematic trading, we call it premium harvesting, that a surprisingly large base of retail traders likes to come in.
Well, that's what I wanted to ask you about. As we talk about all these sophisticated hedging tactics, how much of that is individual retail traders versus what has historically been the institutions that have been doing that kind of activity?
Well, one of the biggest stories over the last few years has been the engagement of retail in listed options. And so you can look at the data in some SEC filings. We see basically about 30 million contracts a day coming from retail brokers.
And that's out of what?
Out of
overall?
about 60 million contracts a day.
So about half.
It is about half. Years ago, it was more like 10%.
Yeah.
And so, and that shift, that shift kind of started during COVID with the meme stock craze, but it has persisted. And then, we see that retail broker community evolving their platforms, doing some really great things in terms of education. And there was a time when I started in the business, the retail brokers were very nervous about options, right? Most of them, even the brokerage teams didn't really understand them very well. They're much happier letting people trade stock. We've evolved, and the tools that are available to retail traders. I mean, some of this trading and the 0DT options is being done, in an automated fashion using some tools that are available that are using the APIs to the retail brokerage platforms, and it adds up. It's tens of thousands of contracts a day, and so it's just been this kind of steady evolution of the market. But yet to see retail, true retail, making up about half of the flow, and in the SPX 0DTE, it's actually a little bit more than half the flow is coming from this retail brokerage community.
That is extraordinary.
Yeah.
Really interesting. Good to see you. Thanks for coming in.
Thanks.
Appreciate it. We got much more markets action coming up. You are watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke Tamama. We're live at the NASDAQ here in Times Square. Let's get a quick check on the latest market action. We're about 2 hours into today's trading session, and the momentum that we saw at the open has continued throughout today. What I do want to point out is once we got Secretary Bessent's comments about the U.S.-China trade war, we did see all three major indices move higher. You could see here on the Dow, also the NASDAQ seeing a similar reaction to that commentary, and the S&P 500 seeing the same. Now, Secretary Bessent did say that their goal with China is not to decouple, but rather to de-risk. And we are seeing some momentum there as well. The NASDAQ holding on to the momentum the most, up about 1%, up more than 250 points, with the Dow up more than 260 points. Taking a closer look at the NASDAQ and what exactly is moving here. We have Apple moving higher based on new tech announcements. We also have Broadcom largely extending the gains that we saw, or rather the gains that we did see throughout the week over the past 10 days. And now if you take a look at AMD, I do want to point out that because on Tuesday, the company announced that Oracle would deploy more than 50,000 of AMD AI chips, and now we are seeing that momentum continue into Wednesday's trading session. It's up 9% just today alone, but up about 10% over the last 3 days. Also quickly taking a look at the Dow, which is mostly in the green as well. Walmart still holding on to the momentum that it's gained during yesterday's session after it announced a partnership with OpenAI to deploy using ChatGPT. Shoppers will now essentially be able to shop on Walmart through ChatGPT and buy their items directly on the app. So that's still gaining momentum from yesterday. Also, we are seeing JP Morgan, Caterpillar, IBM also moving higher today. And I do want to take a look at sectors really quick because we're seeing a renewed momentum to this tech rally, similar to what we've seen throughout this year. And that is leading the tech sector higher in intraday trading. Year to date, this sector is up more than 20%. We're also seeing some momentum when it comes to real estate, utilities. But I do want to point out as well, consumer staples, not necessarily in the red as we've seen throughout this year, time to time. Investors really turning to it as more of a safe haven. And so we're seeing some rotation there as well. But largely, this is a market that has recovered from that pullback right before yesterday's market close. And now we're seeing all three major indices in the green as we make our way into the middle of today's trading session. Keep it right here on Yahoo Finance. We'll be tracking all the market moves, though, throughout the session today.
Apple unveiling fresh updates to its product line that will feature its in-house M5 chip. Joining us to talk about it, Yahoo Finance tech editor Dan Howley. Dan, why is this important? What's the significance of? Because we knew about the M5 chip already, right?
We knew it was going to be coming at some point. They have their M4, their M4 Pro, and every kind of year they roll out a new M series chip. The big deal about this one in particular, though, is that they're focusing heavily on AI. And even if you look at their press announcement for this, and you would talk to Apple, they would say we're updating this chip in particular to improve AI performance overall. Now, this is part of a broader kind of push across the, I know it's a Mac, but a PC landscape. They have this in the MacBook Pro 14-inch, as well as the new iPad Pro. Those are 11 inches and 13 inches. But they all have this new AI improved capability. Microsoft and its partners they have their AI PCs where they focus heavily on AI performance, native AI capabilities. And so that's really, I think, the biggest deal here. Now, the products themselves do get updates outside of AI. They have faster CPUs, they have better GPUs, that's better for gaming and overall performance. They have faster memory, RAM, unified memory, whatever you want to call it, depending, and faster storage overall. So they're generally better devices, but really it is all about the AI here. And obviously Apple has had some issues with their own AI. Siri still not out. Apple Intelligence been a little lackluster, but to their credit, or I guess in their defense, there hasn't really been any kind of AI capability on devices that I've seen yet where I've said, I got to go out and buy that because of the AI.
So what do we know when you say enhanced AI capability on the laptops or whatever, what does that mean? Like
basically that large language models, apps that take advantage of those are going to be faster. You're going to get answers faster. You're going to see better performance in video apps or photo editing apps. That's really the kind of market for the pros, by the way. And so in addition to that, what they're trying to do is set the pros up as kind of an AI developer device as well. So it's not just the folks who, I have friends who are photo editors who, they live on their Mac, or their iPhone. They would continue to use these devices, but now they're trying to say, okay, AI developers, the Mac is a great device for you guys too. And so they're trying to get them over. And, they also, by the way, I'm talking about the Mac a lot, but the iPad with iPad OS 26 has gotten some significant upgrades where you can do a lot more that you would normally think I would need a Mac for. So you can multitask with multiple windows, you can move them around like you would. It's not really, you're not as boxed in as you once were with the iPad. So it's a big upgrade as far as the software, and then this hardware should make it a lot better.
And then finally, I'm curious if they're continuing to use their M5 and maybe M5 in more devices for more capabilities, what chips are they not using from outside vendors?
So they were using Intel for a long time, and they said, we're not going to do that anymore. Look, the difference between the Intel chips in Macs versus Apple's own chips is mind-blowing, right? You can run, this is running an M chip, my MacBook here. I've used them in different review devices. You really can just shut it, open it up, and oh, hey, it's still got power. My wife and I do that at home with our own MacBook Air. And so, it really has been a huge step up for them. They also, in the iPad, though, have their own cellular modem, the CX1 chip, as well as their own Wi-Fi and Bluetooth chip. So they've moved away from Qualcomm in the iPad now, as well as the iPhone Air and the iPhone 16e. So that's going to continue to kind of roll across Apple's offerings. We didn't see it with the iPhone 17 Pro or Pro Max or the base iPhone 17, but it'll get there eventually.
Yeah, interesting. Thanks so much, Dan. Appreciate it.
For sure.
We got much more markets action coming up. You're watching Market Catalysts. The Social Security cost of living adjustment for 2026 is now expected to be announced on October 24th, letting beneficiaries know how much their benefit checks will increase next year. The announcement was originally scheduled for October 15th, but was delayed due to the ongoing government shutdown. The agency adjusts benefits every year due to inflation and uses data from the September CPI report, that's the Consumer Price Index, that was delayed to October 23rd. Projections from the Senior Citizens League expect a COLA increase of about 2.7% next year. That would boost the average retirement benefit by about $54 per month. The Social Security Administration is still expected to notify recipients about the new benefit amount starting in early December. A spokesperson for the agency says benefits will be adjusted starting in January despite the shutdown. More than 70 million people receive Social Security benefits. A new report from Vanguard shows that only about 4 in 10 Americans are currently on track to maintain their lifestyle in retirement. Yahoo Finance's Josh Lipton spoke to Vanguard head of retirement research, Kelly Hahn, about the challenges.
Your retirement report, Kelly, says that 42% of Americans are expected to retire successfully. How do we define success in this context, Kelly?
The success can vary depending on individual needs, but the baseline is being able to have the same comparable lifestyle in retirement as the one that we're leading while we're working. And that's how we defined it, just as a baseline.
4 out of 10 doesn't sound great. What explains that trend?
Well, what explains that trend is the fact that, well, we didn't have defined contribution for all workers. Although 4 and 10 does sound somewhat grim, the bright spots are that for those workers with employer-based savings like defined contribution, they're twice as more likely to be retirement ready. And we also see a significant improvement for younger workers because of the expansion of defined contribution, as well as more robust plan designs that many of the employers are using.
I also want to break down it generationally because there was some interesting data on that too, Kelly. Correct me if I have this right, but it looks like Gen Z and millennials projected to be better prepared than boomers. How do we explain that?
It's really the access to DC that has expanded over the years. So now about 1 in 2 workers in America have defined contribution as their retirement benefit. And defined contribution is such an easy and automated way to save and invest towards retirement, and that it's really boosting younger workers who now have broader access to be retirement ready more so than baby boomers. We see among the plans that we record keep on the Vanguard platform, about 6 in 10 plans are now automatically enrolling people. So what that means is many of those participants or workers are participating towards saving towards their retirement. And the plan features, the default settings have gotten a lot more robust. So the default savings rate is now more than 6% in 1 in 3 plan sponsors that we work with. And when you combine the strong default rate with the employer match, we now see a typical worker saving close to 12%, which is right in line with what we think people should be aiming for.
When you have a 401k, Kelly, are there certain broad goalposts? Like I should have this much by 30, I should have this much by 40?
Well, that really depends because, as we said, the goal or the success measure for individuals is going to vary depending on how much income you are earning. Because the baseline of being able to replace the current lifestyle for someone who's making $50,000 versus someone who's making $300,000 is going to be very varied. But the general rule of thumb that Vanguard has is try and target 12 to 15% of total savings from your own contribution, as well as the benefits that your employers are offering you. And combining your own savings with Social Security, for the most part, we think people are going to be ready to be able to replace their current lifestyle in retirement.
You mentioned Social Security, Kelly. In the report, you also do talk about how the trust fund expected to be depleted by 2033. What are the potential ripple effects of that we need to think about?
Well, the benefit, if we do nothing, is going to be decreased by 23%. And many Americans rely on Social Security, particularly those low-wage earners who don't have the flexibility to save as much towards their retirement outside of what they're already saving in DC. So we need to make sure the bedrock of American retirement system, which is Social Security, is standing on strong footing. So we do need to deal with the trust fund issue.
You mentioned, Kelly, how Gen Z and millennials projected to be in better position than boomers. I am curious, though, student loans and debt, how does that sort of factor into calculations for their retirement, for those relatively younger demos?
Yeah, that's a very good question. The numbers that we show in the report, about 5 in 10 Gen Z is on track to achieving retirement security. And that's accounting for the fact that they tend to have a lot more debt now than the previous generations, the baby boomers at their age had. If they didn't have that much debt, the retirement readiness would be a lot higher. So what we're pointing as part of the solutions, we need to think about not just save and invest, but we need to help people have a plan, financial plan, and also advice in terms of managing their overall balance sheet, not just on the asset side, but also on the liability side.
On boomers, this was an interesting stat, Kelly, in the report. Only the top 30% of earners are ready for retirement. What explains that trend?
Well, I think the baby boomers were caught in the crosshairs of DB to DC transition. So in their peak earning years in their 30s and 40s, that's when defined contribution really started to take off from Pension Protection Act of 2006. And defined benefit, the pension plans from employers, had been on a decline. So for those baby boomers, they didn't benefit from the wider access to defined contribution and also the stronger plan design that have happened over the last couple of decades. But the good news for the baby boomers, those who are falling short, the good news is that they're sitting on home equity. About 3 in 4 baby boomers have some value in their homes. And when they tap home equity, they can meaningfully improve their retirement readiness. Now, tapping home equity isn't an easy decision. It's not a trivial decision because we have very strong emotional attachments to our homes and the communities that we live in. But for people who are falling short, it's a viable option for people to consider.
The AI trade is still red hot, but there's more to it than just a few chips and server stocks. And on today's Stocks in Translation, we are peeking inside the data center and looking for investment opportunities that might be flying under the radar. First, let's break down what the data center actually is. It's compute, plus networks, plus power, plus cooling, plus construction. It's racks of servers and ultra-fast switches, a lot of electricity, along with industrial-grade air conditioning, and all the teams that build it and maintain it 24/7. And here's a quick roadmap to all the components of the data center, from servers and networking to backup power and electrical distribution, cooling the guts of the servers as well as the rooms, plus engineering and construction, to name a few. Now we're going to touch on some of these segments with a few charts. We're starting with the servers because that's where the AI work gets done. Dell and HPE are the big diversified box makers selling AI-ready racks. Supermicro is a high beta pure server play. They're all up more than 60% over the last 6 months, but Supermicro is down about 5% since the most recent China tariff scare last week, while Dell is only off under 1%. Now, let's tackle networking. At the top is NVIDIA. Why is NVIDIA under networking? The world's biggest company is also key in the high-speed networking space, as all those chips have to talk to each other. Arista Networks is up over 90% these 6 months and is the pure-play networking leader in cloud switches. Cisco is a big diversified giant, only up about 20% in that time frame, but actually slightly positive over the China tariff scare, while NVIDIA is down about 5% the last few days, which suggests that NVIDIA is still levered to China. As servers get more dense, they give off tremendous heat, so cooling systems are one of the pick and shovel side of the AI trade. Vertiv touches power and thermal inside the white space and is up 150% over the last half year. It is the leader of the whole data center pack. Meanwhile, Johnson Controls and Carrier run the chilling towers and systems that cool the water, that cools the servers. Carrier is slightly down over the last 6 months, while JCI up nearly 40%. Next up are the companies getting electricity from the grid into the racks. Eaton, SPX Tech, and Schneider Electric make switchgear, breakers, busways, and uninterruptible power systems, or UPS. Both Eaton and SPX Tech are up modestly over the last few days and are up more than 35% over the last 6 months. And when the grid cannot keep up, these are your backup engines, keeping those chips crunching numbers. Industrial heavyweight Caterpillar has been flying since September and is up nearly 80% the last 6 months. It's also up over 6% the last few days as many of its peers have stumbled. Cummins is another big name, up over 40% the last half year. And you've probably heard of Rolls-Royce Autos, but they've also got a power solutions business, and that ticker is up about 60% over the last 6 months. And we'll finish here with Jacobs, the engineer that designs and permits, as well as Trane, which is a premium air conditioning name. They can both signal how healthy big projects are. So not only are these companies bellwethers of the AI pipelines, they both happen to be up a few percentage points since last week's China scare. With earnings season upon us, here is what to watch next. NVIDIA is out November 19th and Arista is reporting November 4th. Aside from the big headline numbers, watch for deeper networking pushes and what it means for orders. Dell and HPE, they are out late November, early December. Notice if they mention an AI server backlog and what they say about deliveries and margins. Then on the power front, Vertiv reports October 22nd and ETN on Halloween. Watch for pricing power and lead times. Can they still raise their prices? And what are the lead times? And sticking with power, Caterpillar is out October 26th and Cummins reports November 6th. One big question, are data centers still adding backup capacity? Then what's the grid strain? As far as investing goes, it's always a good idea to only buy what you understand. And remember, this right here is just a quick guide, so do your homework and always match your investments to your risk tolerance. And tune in to Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast. Stay tuned for more market catalysts up next.
Supertanker freight rates surged this week on a hike in U.S.-China tit-for-tat port fees. On Friday, China announced retaliatory fees that, by one estimate, would add more than $7 a barrel in shipping costs for a large crude carrier linked to the U.S., equaling about $15 million overall. That's according to Reuters. Let's talk more about the situation with Stamatis Tsantanis, Synergy Maritime CEO. Thanks so much for being here, Stamatis. So what are we seeing in terms of on-the-ground port fees and how that's affecting your business?
Well, thank you, and good morning to everybody. Thanks for having me. It's kind of a crazy situation, to be honest. We used to have the USTR, and we still have the upcoming implementation of the USTR, which is the US port fees to the Chinese related ships. And the Chinese government last Friday decided, in retaliation to the USTR, to impose port fees and tariffs on US-related ships. And that's a multiple amount of money for every port call of US-related ships to China. So, I mean, USTR, you could have said, okay, that might be some logic behind the actual amount associated with the port call. But now, for our ships, which of course are not affected by that, we're talking about a similar ship like ours, $4.5 to $5 million per ship per call to China. So you can imagine that's an amount which is exorbitant. So this is the kind of situation that we faced, and that came up last Friday.
Are you passing those costs on to customers? Are you eating the costs? Well, how is that working?
Well, that's the thing. I mean, eventually all the costs are being passed down to the customers. So it all falls down the actual chain of things. So it will fall down to the actual consumer, and that's going to make things way more expensive. But it's a very punitive measure from the Chinese government to actually impose this kind of tariffs and port costs to the U.S.-related ships, and it's a very confusing situation all of a sudden.
How long do you expect it to last?
Well, the other interesting fact is that while we have all this groundbreaking news about tariffs here and there, USTR, the Chinese ones, the U.S. government is closed. It all coincides with the fact that the U.S. government is closed, so we cannot really get an answer from the U.S. Government officials as to what they're going to do. And we do not have any clarity from the Chinese officials as to what ships will actually be affected. But this measure was actually enforced today, and it's ongoing. So people end up paying this exorbitant amount without having any clarity as to how long this is going to continue. It only makes things way more expensive and complicated for us.
And is there any way of sort of navigating around it, right? I mean, we've seen the companies in the U.S. that have dealt with tariffs, find all kinds of ways to try to either pass on the cost. I mean, if you're a manufacturer, you can try and move where you manufacture. I don't know that you guys have a lot of options in the shipping industry.
Well, there are not so many options, to be honest. The problem here is that a lot of companies are doing certain measures which, in my opinion, are kind of abrupt. We're seeing a lot of international shipping companies with U.S. directors that were above the threshold of 25% in respect of directors, and they have been asking directors to resign in order to fall below the 25% threshold. We at Synergy were not affected. We have an 18%, let's say, associated U.S. ownership, which is good, and our board representation is only one U.S. director compared to the other 5, so we're not affected by that. But we're seeing companies asking directors to resign, U.S. Directors to resign. So that's an abrupt move, and that's kind of penalizing. I mean, asking people to resign just because you're going to be paying this exorbitant fees. I don't know. This has to be some sort of a solution pretty quick. Otherwise, it's only going to get more complicated.
And so, bottom line, this is going to effectively be inflationary for the U.S., for other countries. What effect?
It's absolutely inflationary. People do not understand that everything transported by sea, which is 90% of the global trade, whether these are raw materials, products, finished products, you name it, it all ends up to the consumer, which is going to pay more for the actual products being used, whether that's the steel for construction, whether that's the scarves or the Amazon products. So it's only going to get way more expensive. So there has to be some solution nearby, because it only inflicts pain to the actual consumer. It's as simple as that.
Stamatis, thank you so much for your perspective, and good luck to you. Thank you.
It's a great pleasure. Thank you.
That's it for Market Catalyst. I'm Julie Hyman. More Yahoo Finance coming up.